Great last panel. Let's have some fun here, guys. It's a great week in Miami. What do you guys think, Miami, so far? I grew up. Yeah.
Hot, fucking hot.
Anything other than you got the suit on?
Well, I live here, and
Okay.
so I love it. It's awesome. Best city in America.
I would say, can you imagine the vibes if the market were up? I mean, it's been kind of an incredible week in terms of energy level and attendance and all that sort of stuff in a down market. I mean, I think it's been a great conference overall.
Yeah. Market was up a little bit yesterday. I saw NIR was up 16%. Zcash had a ripper. Okay, so we've got HODL, ZODL, BitGo, Grayscale. We're going to be talking about who secures the assets, custody risk, and confidential execution. Well, why don't we go down the list? I don't think I've had the pleasure of meet you guys aside from Zach. Zach was on our show a little while ago, and I want to use something that Zach said in that episode as kind of the pretense for custody. And I think Zach knows what I'm going to allude to because we were talking about the tokenization super cycle, and it really feels like, first we tokenize the assets, they come on chain, they go into all these DeFi primitives, and then all of a sudden you do get this massive repricing because this absolute storm of assets has now entered the arena. And so what was the biggest thing holding that up? Zach said institutional custody. So we'll go down the list, we'll get custody risk and confidential execution. But just starting with custody, Zach, maybe you could just expand upon this idea of what is currently holding up the tokenization super cycle and why you think it's institutional custody.
Yeah, a lot of kind of elements to that story, but just building on that previous conversation, how we think about it is the financial system. That's what we're rebuilding is the financial system that connects savers and investors, or people that have capital to lend and people that need capital to borrow. And so we can tokenize assets all day long. But if there's not a way to bring the capital deployers, the savers, the people that are investing in these funds on chain effectively, there's no point to it. And so one of the things that holds back this wave in our view is just we're not quite there yet for the big boys of institutional finance to be doing self-custody, having their own wallets. The infrastructure is almost there, but certainly it's not deployed at scale. When you go into Morgan Stanley, you go into Wells Fargo, and you go into other partners, they're still very much at the ETF. They want that custody provided for them in the form of the ETF, and they want the wrapper to go in traditional brokerage accounts. When we get there, when we get to the point where we have institutional wallets and self-custody, we're going to be able to unlock the tokenization wave in a much bigger way, in our view.
Yeah. Okay, so setting the stage here, we've now got almost all of the pieces where we're ready for trillions or more in assets. It feels, and I mentioned this earlier, it feels like we've got this three-headed dragon, Zcash, NIR, and Hyperliquid. Using these as sort of the foray through which I think a lot of people are kind of looking at and entering the ecosystem. We've got a varying set of approaches. Zcash got, shielded, and we've got ZODL here, and Hyperliquid's got, their approach and deposits, self-custody and such. And then we've obviously got the more institutional front. When we're looking at, kind of the landscape here, how do we ultimately get these things all composable? I think that's where we really start to unlock what, the value proposition of this new financial system can really do. Maybe Tony, we'll start with you and we'll kind of come down the line. Privacy feels like it's in the room with us all the time, but we can't really see it. We don't quite know how to integrate it. If we can get it to a point where, we leverage the privacy of Zcash in addition to these other assets, everything becomes composable together. Feels like that's a massive value that's unlocked. Maybe you could speak to how you guys have approached this at ZODL and how we can bring privacy to the rest of the ecosystem.
Yeah, that's a great question. So at ZODL, one of the things that we did to really, bring Zcash to other ecosystems was we integrated NIR Intents. And obviously it's topical here, and Alex just had a good talk on it, but historically, Zcash has always had really groundbreaking tech, zero-knowledge proofs. We implemented those back in 2016. But I think it was a little bit isolated in its own ecosystem. And so now with NIR Intents, and one of the features I'll call out is cross-pay, because this plays into agentic commerce. But If a vendor or if my friend only wants to accept USDC or Bitcoin or ETH within Zottle, I'm able to store my wealth shielded in Zcash, and I can pay them exactly the amount in whatever currency they want, any currency that's supported by Near Intents. And that's a big deal. It's kind of like meeting people where they're at. If you look at, Agenta Commerce or whatever, if I have an agent out there that I want to go make a purchase on Amazon or go book a flight and, they don't accept shielded Zcash, well, that's fine. Through our partnership with Near Intents, we're able to, those payments can be executed as well.
Can I just pile on one quick thing on Zottle, not to hog the mic here, but I'd love, think about it inbound as well. Everybody that has spent some time doing, but I'd just like to pitch, think about it inbound as well. Everybody that has spent some time in crypto has some assets scattered all over different chains. You probably got some BNB chain stuff. You probably got some Avalanche stuff. When was the last time you looked at these assets? Zottle and Zcash can be a private hub for your on-chain wealth. Clean up your on-chain life and bring these with Near Intents into a shielded pool. And then, who knows what you might do with those assets in the future. But what a great place to sort of hold these. Zottle is mandatory self-custody. Default shielded assets. You can kind of sweep up your on-chain life into a shielded pool. To me, it's like a great use case of both of these tools: the wallet, the chain, and Near Intents.
Yeah.
All right. Sorry, I just love it. Had to get that pitch across.
Good pitch. So at HODL, actually, we have some unsolved challenges which we're waiting for some evolution to happen in the space. We do tokenized hedge fund strategies, which means that people can access them on chain as well, just directly on our website, the HODL protocol. But you can also see it on chain. Perhaps somebody could see all of your holdings. You can also see the smart contracts that are executing trades, what they're executing. Now, obviously, reverse engineering that is difficult and might not be worth it. But there's a challenge there that as we get more consolidation in the market, there's less and less strategies, less funds that are providing those strategies, then it'll make more economic sense to try and copy or reverse engineer and front run them. So we're looking forward to actually seeing how we can work with Near as well. And eventually, if there's a standard that's developed, there's like some standardization in the space about how we expect privacy to work. Like in TradFi, there's different types of certifications and SOX compliance and other standards. If that comes to digital assets, and it'll be great. Yeah.
But ultimately, who hates privacy is regulators. So like when we think about the evolution of where we're at now, like if BitGo, right, we're an OCC chartered bank. We have 7 regulatory licenses globally, $100 billion in assets. 2 years ago, we couldn't get a bank account. So like when it came to regulators or people coming to us and say, hey, we want to hold these assets, we want to deploy these sort of things. At the time, we were state chartered trust. A difficult thing. Tell us about these transactions. Like we could. Privacy was kind of a difficult thing. We didn't support a lot of the tokens because regulators hated it, and we were trying to run a business. And so now we're at a point where like privacy is becoming, there's always the fund running and all these sort of things, but from a custodial perspective, it's really difficult because we don't want we don't want people to look at BitGo wallets and say we can understand and start tracing these. Like we're thinking about ways that we can shield, for lack of a better term, these sort of positions. But at the end of the day, having even this conversation is a little bit more privileged than it was a year and a half ago.
So before we get too deep into this confidential execution realm, let's just come back to the custody conversation. When it comes to the institutional custody, Zach, you mentioned, this is kind of holding up some of this tokenization super cycle, especially having an on-prem solution for these things. I mean, Nathan, would you argue that, we actually have it solved? BitGo is the solution for that?
No, because you can go on chain and see BitGo wallets. I mean, we get wallets that are tagged. Like people can see transactions of some of our largest clients. If you're a large organization, let's say a VC shop that owns a sizable portion of an asset, if you put that into an environment, no matter how many wallets you split it up into, they can see the base and they can start tracking those sort of things. So it's really hard to actually we have, clients who own sizable amounts, the low float, high FDV sort of positions, and it's really hard to get away from tracking that. Now, in the world of publicly traded companies, like, you can't just sell off a position and not tell anybody if you have a sizable position. So, like, there's some things on privacy maybe being not the greatest solution, because it is trying to shield from, like, what's going on in the market if you are a key decision maker or a position in that holdings. But, like, ultimately, for us, like, we don't want all our wallets to be exposed, not because we're trying to hide things, but we are trying to create some level of confidentiality internally.
Zach, just to kind of come back here, like, what do you currently see with BitGo that, as just a custody example, right? There's lots of institutional custody providers, but we got BitGo, Nathan's here on the panel here. So, like,
Shout out BitGo. Yeah.
Shout out BitGo.
Shout out.
What could we do? Like, how do we overcome this current environment of custody and ultimately reach the catalyst of unlocking this next wave?
We're really getting there, and really shout out to BitGo. Of course, a U.S. publicly traded company leading the industry in this kind of stuff, groundbreaking in many ways. And Mike is an OG and somebody who I think is very thoughtful on all the complex issues around this topic. Look, I think for me the answer is kind of a demand pull thing. You have to have a reason for institutional capital to get on chain in the first place. What is the asset that they want to go get? Bitcoin was a start of that process. Can we make unique types of tokenized assets or unique tokens? Like, say, the tokenized Galaxy share example. Something that only exists on chain. I think that ecosystem will grow a lot, and it'll be a demand pull thing. Institutions will say, I got to get on chain because I have to get that asset. We're not quite there yet, but I think that is the thing that ultimately forces us forward.
And then obviously, we've talked about privacy, confidentiality as it pertains to custody, as well as execution a bit, custody as well. The boogeyman here is the risk. Like, we've seen far too many hacks over the last, even call it weeks to months. It feels like it's increased, it's accelerated. We know that there was this massive Bybit hack a while ago. So by, cumulative, hacked assets, maybe it's not the biggest in terms of what we're on pace to this year, but the amount of protocols feels very, very vulnerable. How do we overcome this? It feels like if we stick to our roots and we're decentralized, maybe we can prevent a lot of this. But I'm just curious, how does it start at the custody layer, or is there something else that we can embed into this ecosystem, risk controls, asset controls, that ultimately mitigates a lot of the risk that we're seeing right now?
I mean, in our case, I think we recognize that it's the biggest risk, and it might actually get worse because of what we saw with, like, Drift and the social engineering aspect. Because as more people actually get involved in DeFi and digital assets, but especially the DeFi side of things, then there's more potential targets. So you have and also the equation is control versus versus kind of, so if you have more control, maybe you can prevent a hack, but then you also have control, so you could be a perpetrator, like a bad actor, insider risk. So there's both of those things. But the insider risk could be mitigated if governments decide that, okay, just because you have control doesn't make something a security, because right now that's one of the big, like, pillars of how you avoid having your protocol's token be considered a security is, can you control, or do you have discretion or authority over, like, trading, for example, that happens if it's a vault product in that vault. So protocols try to eliminate the control factor, but by doing so, if there is a hack, they essentially have no choice other than maybe to shut it down.
So I'd chime in and say that, privacy isn't about hiding anything. It's really about mitigating your exposure. And it's hard to hack what you can't see. At the end of the day, if you can't see balances, if you can't see transactions, your transaction graph is really your risk exposure. Every time you're making public transactions on chain, with AI, that becomes trivial to track patterns and to track balances, and so, like, as I think Alex from Near was talking about earlier, it's in our normal daily lives. Like, when I go buy groceries at the grocery store, I'm not, showing the cashier my account, my account statement and all my transaction history. But when you're transacting on chain on a public ledger, you are doing that, and it does make you a target.
And as we approach this, we're seeing more of these products in terms of RWAs, tokenized, products, kind of starting with stable coins, treasuries, kind of going down the risk curve there. Is there creative ways that we can get creative with custody, with privacy, in which, maybe there's limited movement of the underlying, but, we have very robust and liquid products?
There are versions of some of that today in a centralized fashion, right? So like different custodians have different methods. I can speak to what BitGo does. We have something called the Go Network, where it's essentially an omnibus wallet. So you have one wallet address, and because we're a bank, we can segregate on our books and records. So ultimately, let's say you have counterparty A interacting with counterparty B, and we're settling between those folks. The asset doesn't actually move on chain; it just moves on our own books and records. That's great if you're on BitGo, but if you want to transact outside BitGo, the asset has to leave. So these are some of the things that we've done to try to help mitigate some of the questions earlier, which was like, not seeing all these positions move all the time, but as soon as you need to leave that environment, you're going to see the transaction happen. So we do things like that, but outside of that, that's how we handle it.
I know we got some things to add. I just want to build on this by saying this is going to continue to be, we're seeing more institutions enter the space. This is only going to be a growing issue of fragmentation.
Yeah.
Just want to put that out.
Yeah, absolutely. One, I think, example, of course, of a way that you can provide liquidity to these assets while keeping custody more secure is the ETFs. This is one of the reasons that they're a solution. Only a portion of the ETFs need to be kept liquid to meet creation and redemptions. Much of it can be kept in cold storage. And as long as there's a buyer and seller ready at the current price, you actually don't need to create and redeem all day long. It's only when there's a kind of big imbalance between buyers and sellers. So there's a lot of volume that happens on an exchange order book on the ETFs, and there's no coins moving on chain. When you look at the Bitcoin blockchain, active addresses are actually trending down. And of course, this is a question about the health of the ecosystem, but part of it is just the ETFs. There's a lot of volume that's happening in a secondary market, doesn't need to be transacted on chain. And yes, that means there are fewer active addresses, but it also means users are able to get liquid access to Bitcoin without taking any new custody risk. In that sense, it's providing a service.
So I'll just share something that I've been tangling with personally over the last few weeks here as we've seen more of this progress. To take an asset that's native on chain, put it into an ETF, but then tokenize that ETF. It feels convoluted. Can you guys help diagnose this? What is this ultimately the right structure?
No.
It's not. Okay. It feels like it shouldn't be, but maybe we can understand why this is happening now and maybe how we can improve from here.
I'll just add one thing. So in the long run, no, it doesn't make sense to move something in crypto and put it in a TradFi wrapper and then move it back to crypto. In some conceptual sense, why are we doing that? That being said, I think there probably is a little bit of room to do something, and that's because the TradFi stuff has something to offer crypto. What could that be? Well, maybe it is some kind of cross-chain custody. You could hold a multi-token exposure, for example, without having to use bridges. You could have an index pricing methodology and automatic rebalancing, and those things are not necessarily available on-chain. You could have audit and other compliance types of functionalities. And so, some of these things are kind of exports from TradFi to crypto, and so maybe tokenizing an ETF could make sense in some narrow cases.
Once they become available on chain, these things, then
Yes, in the longer run, I couldn't agree more.
Okay.
These things are ultimately all moving on chain. It's a temporary solution, though.
Doesn't it come to the question though, why the products were created in the first place, right? So if you let's look at asset management as a whole, right? So before I got into crypto, however many years ago, I worked at Transamerica Capital on the wholesaling side. So if you take an asset like Bitcoin, where if you're an advisor at Merrill Lynch, Wells Fargo, wherever, you can't allocate to that. Your systems aren't set up for it. If you're an RIA, you're not looking for custodians because you're scared shitless of the space. So ultimately, you're okay, I am comfortable with an ETF structure. So, start off GBTC and some of these assets that ultimately got you exposure using a vehicle that they're comfortable with, and they can get their compliance departments and risk and hold it at Pershing and all these other things. So then you take that and you expand it into other assets, ETH, SOL, so on and so forth. So now allocators can go into it. The next kind of leg of that in some ways is, there's obviously the tokenized asset, and I'll come back to that, but then you have digital asset treasuries. We say, okay, ultimately, I want to get exposure to an underlying asset, but I don't want to own an ETF. I want to own an equity position, not an ETF position, and I buy a DAT. Then
Just quickly, why might someone want an equity position and not an ETF?
it could be investment policy statement on how they actually structure funds or how they can, like, what type of assets they can hold. Like, so for instance, how is a digital asset treasury quantify as an equity position, or is it quantify as a cryptocurrency? Like, if I'm a large cap equity, if I'm a mid cap equity manager, a small cap, like, I can't buy, the NEO DAT. I know Sal couldn't make it today, but the NEO DAT, but I can buy I can't buy the NEO asset, but I can buy the NEO DAT because it's an equity. So it's a different way to get exposure. That's kind of how I thought too about, and then the whole kind of DAT thing kind of went a little sideways. And so ultimately what led into, now we think about the tokenization of, like, why do you tokenize an asset? Well, if you tokenize Microsoft and Apple and these sort of stocks, who are the users of that? It's typically people who can't open a U.S. brokerage account. It's somebody overseas. It's in Africa, or in Europe, or whatever you're else. And so ultimately, like, if you bring the ETFs back into these tokenized structure, again, why are you doing that? Is because you want to borrow against it, and so a DeFi pool, a lending pool, and you want to do it natively? Is it because you can't actually get exposure in the U.S. markets because you sit somewhere where that doesn't really exist? And so, like, ultimately, I think, to your point, like, people creating products just to create products don't make any sense, but, like, there is a reason why some of these are going to be, if you think about it, kind of like, at the end of the day, who's the allocator?
This occurs in my mind, Tony, like, as you think through the evolution of assets, and obviously you guys are geared towards Zcash, but circling back to custody a bit, I think we will see tokenized equities for all the reasons that Nathan mentioned, access, as well as DeFi, composability, these sorts of things. What does asset breadth mean to someone like a Zottle? You guys are, primarily focused on Zcash, maybe more broadly focused on privacy. Is there components that of privacy in particular, that we can apply to a tokenized Microsoft equity? Is that even in the realm of possibilities of what you guys are thinking?
Yeah, that's a good question. I think like you said, Zottle is a Zcash only wallet. We allow swaps in and out of other currencies. If you look at just the underlying technology with zero-knowledge proofs, zero-knowledge proofs are just a way to prove something without disclosing counterparty information. Whether that's on the Zcash blockchain, for example, there's a transaction hash, but there's no sender, there's no receiver, and there's no amount. So it's not something we're really focused on at this time. But if you think about something like tokenized equities, like, it would be a way to prove ownership without disclosing, additional information.
Yeah, please.
I was actually going to say you're basically centralizing trust in the protocol rather than in everyone, right? Is that accurate?
Yeah. I mean, trusting code, trusting the protocol versus trusting, different counterparties.
Yeah. Thinking a bit more about, I'm curious about the ETF wrapper here, like, around some of these assets. Is there a regulatory component? There's obviously things up in the air with the Clarity Act and whatnot, but Zach, do you think we'll see something where, we get some exemption where, it becomes more accessible to just go directly to these assets on chain?
We do need some regulatory clarity to unlock all this stuff. Maybe going back to the example of why might you tokenize an ETF or something else? I think a lot of good examples have been brought up. Maybe it's composable in DeFi. I can trade it on an AMM, but only hypothetically. Actually, that is not actually allowed in the current system. A decentralized exchange would have to be some kind of a broker-dealer and meet some certain standards. So one of the reasons that tokenized assets on chain don't seem to be maybe doing as much as we would imagine. It would seem like if it were fully unlocked, there would be a richer ecosystem of tokenized assets, and really that is a regulatory barrier. We need some kind of exemption so that, say, a tokenized asset, a tokenized stock can be traded in an AMM pool. That is not the case today. So that'll get pushed forward over time, but we're not quite there yet. So what should somebody like Grayscale do? You either do something now just to have a toe in the water, but it's not actually going to be a big business very, very soon. So you can either do something now just to have it done, or you can kind of wait for that clarity and then execute at that time. I think really that's where we're at. We're not totally ready to see the tokenized asset vision come to life, and we're getting close, but we need some of those further regulatory unlocks.
Just to add, I hope what Zach is saying comes true, because we have to do some convoluted, things to allow basically a user that invests in a vault that's actually an equities strategy. You have to then take the deposit off chain and execute through like a prime broker to buy whatever equities and other instruments are part of that actively managed strategy, and then do the whole thing in reverse if they redeem. And so the two solutions would be just have all equities tokenized, or have a custodian that's both a traditional finance custodian and a digital assets custodian at the same time. Maybe it exists, but yeah, that would be what we would love to see happen.
We're working through trying to hold, traditional structures, right? So like, we're crypto native in the sense that like, we're really good at holding digital assets. We have the ability to hold securities, right? So we're working through things like that, but it's, it's an operational thing, it's structurals, but I mean, and now you're gonna have the vice versa. You're gonna have those large names start looking at us to use infra, so it'll come.
I'd imagine that there's a lot more demand, kind of to your point, once you have the custody structure, what are some of those conversations like? How much have you looked at expanding the asset universe beyond crypto native tokens to more, RWA centric to unlock some of this more native tokenized equity composability?
We bought a company a few years ago called Brassica, which is a transfer agent. So we've been down this path for a while. Brassica today has its own licenses, and it does hold traditional. Right now, BitGo Bank and Trust is continuing to try to think through how we do that. And we have some ideas in place, and now that we're public, I'm a little less of what I can and can't say. And so, but ultimately, what it leads to is the ones that are holding. I think it's very important for us to be able to do both. Just like I think the ones that are holding traditional today thinks it's important to hold digital. So.
I'd imagine a lot more companies are thinking in this direction. It feels like we're, no longer just, a crypto native ecosystem and then, TradFi ecosystem, as they call it. This is just finance. We're going to just have finance companies. This is just a finance event, a finance conference. Miami's a finance city. Guys, thank you so much for listening, watching this panel, being with us here today. Give it up for our panelists. Thank you so much, guys.
Thanks for having me.
Thanks, guys.
It was a pleasure.